Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim. Here we are. On Friday, we get together and review the markets.
And we also love to answer listener questions from our good friend Kate. Bob, I'm confused about where all this is heading and how sustainable it is. I've read that the ECB, the European Central Bank, is now buying corporate bonds at countries outside the EU. The SNB continues to buy U.S. FANG stocks, and the Fed is buying ever-increasing amounts of junk bonds, municipals, anything, I guess, with the word bond on it. Corporations are loading up big time on debt again. The Fed's Powell says not to worry. The Fed will inflate the debt away and continue to inflate asset prices. Meanwhile, the U.S. dollar is in a nosedive. But the consumer is overburdened with debt, many with stagnant wages, or they're unemployed. Is this a V-shaped recovery with hyperinflation going forward, or will we see a deflationary market crash? Pretty complicated question here, Bob, but I know you can answer it.
It's timely, and it's actually many phases to the question, but it all unites. So, Kate, good question. And all of it heading, it's financial violence that has been extraordinary, and that's how it gets out of it is, of course, key to your question. And the European Central Bank buying corporate bonds, I saw one the other day where corporations in Europe are creating new issues just to sell to the ECB. So it's crazy, but what they and then, of course, you've got the Swiss National Bank continues to buy FANG stocks, but I just took a look at the Swiss National Bank stock chart, and sure, it went through the crash and the rebound, but for the last couple of months, it's just gone sideways. So it doesn't look like the Swiss National Bank has the right portfolio of stocks for this thing. And a national bank taking what should be considered reserves and buying stocks with it is crazy anyways. I mean, over all of history, the one good reserve for a central bank is gold, cash, specie, or whatever you want to call it, coin or bars. Now, let's go along a little further with this. And, of course, the Fed Chairman Powell says not to worry, but that's the public man speaking. He cannot come out and say conditions are dangerous. He has to imply that they can fix things. And then the other part of the question is, can they inflate the debt away? And all of history says that once you've had a great credit bubble and the contraction starts, it goes a long ways. And what happens, Kate, is that the hardship and unemployment you get with a contraction always inspires intellectuals to come up with a personal revelation. And the revelation is that, more credit from somewhere will make a credit contraction go away, and yet the credit contraction was due to too much credit. So actually, this goes back to, there was a boom, ended in 1618 and crashed very hard, and an intellectual, as I call him, he was a mercantilist intellectual, Edward Misselden, he wrote a paper, and it included the suggestion that all would be better if credit from somewhere would come and make the credit contraction go away. Then, but so there's been every time there is a bust in the markets, a serious bust, it'll always prompt somebody to come up with the remedy. And then Keynes, of course, was the example in the early 1930s who thought that he was inventing this idea, that he was the originator of it, but he knew so little about economic and financial history that he didn't know that the same suggestion had been suggested almost every century since 1622. So anyways, the street is saying that it's all the inflationists are back in hot action now. You got gold over $2,000 and the calls are now for $15,000 and the dollar's going to go to zero. But no, we think that this is not the case. The dollar index soared to 104 in the March convulsion and crash, and that is the way it works. The dollar goes up, the senior currency goes up in a contraction, and that's relative to other currencies as well as relative to commodities. So at the moment, the action in the U.S. dollar index, the DX, is very oversold. It's showing on our systems, our technical measures, and so it's getting very close to setting a bottom here and recovering. And then the other question is about whether this would be a V-shaped recovery. Well, you've had a financial crash that killed a lot of items and then straight up since. So you've had a V bottom in some of the financial items. And it would be tempting for many analysts to conclude that the economy would do the V bottom, but I'd rather point out that last year the change in the yield curve to inverted said that the U.S. was going to have a recession. And so what we're looking at is a credit contraction, and then the last part of the question was whether we'd go to hyperinflation, which is a very elusive thing when you're in the senior economy and senior currency. It just can't be done. But also then the next part, we see a deflationary market crash. And yeah, that is likely mainly because of history. The history is that you had a long period of rising commodity prices that ends with an inflationary boom. That was, we had high commodities in 2008, 2011. Then that sets up a decade approximately of inflation in financial assets, inflation in stocks and bonds. And if you look at Germany, where their interest rates for the 10-year note got to minus, now that is some form of hyperinflation, I'll tell you. But it is in financial assets. And then at the end of every crazy mania in financial assets, it goes into a crash. And then a long period of credit deflation, deflation in asset prices. And while the street is all worked up about inflation now, that I doubt that it's going to be the case. All the items seem in place such that we're going to have a serious contraction and weak to declining prices.
Our listener Michael asks, many financial analysts are saying this is the end of the U.S. dollar, some people calling it the king dollar. Some have assured that it's going to decline 50% over the next few months. Are these predictions contrarian indicators? It seems like the dollar is extremely oversold and the equity markets are extremely overbought. Will king dollar rise again, or will it perhaps abdicate?
Yeah, Michael, I like your throwing in the term king dollar. Yeah, as we covered the previous question, the dollar index right now is very oversold, and I guess the hottest speculative items against that have been gold and silver. silver has been wild. I think it was up 5.5% yesterday. So that's the story about inflation coming back and the dollar losing its reserve status is in the market, and it shows up in technical measures. And I think this is getting very close to reversing. So I think the next buzz maybe will be some silver analysts saying, we don't understand why silver is going down. It could happen. Michael, thanks for the question.
We'll have more with Bob Hoye right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Bob Hoye. Bob, retail rents have plummeted in New York City, and people are reporting there that U.S. glitzy shopping districts are now ghost towns. Can they recover?
Well, it's hard to say because, as you know, we've been talking about a natural credit contraction following the excesses. And there would have been a decline in the stock market and the economy anyways. But it's been made hugely dramatic by socialists in every political party and in every country using this Wuhan flu as a reason to shut down the economy. As I've been saying, it's never happened before deliberately. The only time you had streets really empty in a severe economic contraction was in London in 1665 when the Black Death hit, the old bubonic plague. And the number I saw was about 20% of London's population died in about an 8-month window. So, and that's not like 20% of those who got the disease died. No, it was 20% of everybody. And that really shut things down. So this one is extraordinary because there has never been a deliberate shutdown of an economy like this. But I think folks are getting onto it and realizing that it's not necessary and that life should go back to normal. Sweden showed that it could be done successfully. They did not shut down, lockdown, or whatever they call it, and their mortality rates and affliction rates are no worse than anywhere else, and definitely not as bad as in New York City, which New York government seemed to do everything wrong. So, anyways, the streets in some of the top shopping areas in Manhattan, it's confirmed by here in Vancouver. Longtime friend of mine is a real estate guy and has a number of retail outlets, and he just says that people are buying consumables like groceries. Oh, and I'd say booze as well, but they're not buying anything else. So it's unusual what's going on, and what restores back to normality, I don't know, but I do know that we're only a number of months into a credit contraction that could last for a few years.
Well, I know things are not selling. They're not selling dress pants. Guys working at home are wearing sweatpants, and they're not selling bras because the first thing women told me they ditched was wearing a bra around the house.
Well, less wear and tear.
Less wear and tear and more comfort.
Yeah. Well, I don't know about those things, so.
We'll have more with Bob Hoye right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF.
surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Turkish stock market has taken a pounding. What's the story there, and what is it telling us for the rest of the stock markets?
Yeah, on the last week or so, there's a couple of stories about Turkey. One was burns through reserves. That means the central bank ran out of reserves. And then another one, Turkish stocks slump on lira concerns, so they got the currency concern. And then there's another one here, that Turkish lira strain shows as London overnight rate soar. So it's one of these little country at the moment sudden disappearance of liquidity. But we want to go back to the first part of last year, where it was Argentina and Turkey suddenly found that they were running out of reserves. And then about June it was, where India had suddenly run out of reserves, and then China. So that's where we then said, well, with this kind of thing happening, and it's happened before, it'll probably be discovered in New York in the fall. And then indeed it was September the 9th, when all of a sudden the Fed was injecting money through the repo into the New York money market like crazy. And that was, the more they put in, the more it indicated that the credit disappearance was really quite severe. But for whatever reasons, the stock market wanted to go up until January. But the big thing on numbers, Jim, was that last summer, the yield curve, which is the difference between short rates and long rates, inverted. And that's where short rates get higher than long rates, and that's driven by speculation. And we've got the chart on the yield curve back to 1857. And the observation is that every inversion has been followed by a recession. So here we are. So this, where many, most people I'd say, or most analysts are saying that the decline in the U.S. economy is due to the coronavirus, we would point out that it is a classic change to a credit contraction that was signaled by changes in the credit markets. And indeed, in January, the yield curve inverted again. So then we looked back and said, well, when was the last time you had that kind of double inversion in the curve? And that was in 2007. And we know what followed after that. And then in looking back, it also happened at the end of the bubble in 1929. And then the only previous bubble prior to that, the one before that, was the one in 1873, and it did the same thing. The yield curve had two attempts at inversion, and in each was followed by a severe contraction. So the credit markets through most of last year and into January were showing that a contraction was at hand. And as I said, the action by the socialists in shutting down the global economy just made it more dramatic than what would happen otherwise. So, but now here, last year we had problems in Turkey and Argentina at the same time. Now Argentina is just cleaning up some of its previous bad debt, and again, investors are helping them out, which is crazy. But at any rate, at the moment, Argentina has good news because somebody has kind of bailed them out for the moment, but that may not last too long. So what we want to watch for is other countries suddenly discovering that their central bank has run out of reserves. So we'll be watching for it.
Bob, thank you so much for chatting with us.
Jim, it's been good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. As you heard, Bob loves to answer your questions. You can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.